Happy New Year, chart watchers, and welcome to this Wednesday, January 2nd, 2019 Market Watchers live show with your hosts, Tom Boley and Erin Swenlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, 2018 ended. We did rally a little bit toward the end of December, but it was a pretty rough ending. Quarter four, not good. Started off pretty rough this morning, but we have bounced back from those earlier lows. You can see the Dow Jones Industrial Average currently down 131 points. The S&P 500 down 11 and change. The NASDAQ down 18. The Russell 2000 currently up about 2 points, so outperforming on a relative basis. 10-year Treasury yield, though, continues to go lower. We really haven't seen much of a bounce here. The 10-year Treasury yield today down another 2 basis points, 2.67%. Volatility index, about a week ago, we hit levels that we typically see a bounce from. The last two bear market breakdowns, volatility reached 37 and 34. That's about what we saw last week before we got the bounce in the market and the reduction in the VIX. But this is still problematic as we go into 2019. We'll surely be talking about this quite a bit in the weeks ahead. Energy is actually leading to the upside today. I know crude oil earlier was up more than 4%. I think it's pulled back a little bit. I haven't checked in a little, maybe the last 20 minutes or so, but I do think that the crude oil prices bouncing, having a nice impact on energy. Within industry groups, gambling stocks having a pretty nice day today, although they are challenging some overhead price resistance and the 50-day moving average, or excuse me, 20-day moving average. Banks also having a nice day today, which is a little surprising given the big drop that we've seen in the 10-year Treasury yield, but maybe just an oversold bounce. We'll keep an eye on that. In the energy space, though, two of the leaders on the Dow Jones, ExxonMobil and Chevron, both having nice days today as a result of higher crude oil prices. And the top performer in the S&P 500 as of about 30 minutes ago was General Electric, GE, trying to take out key highs at about $8 where we have failed over the past 6 to 7 weeks, currently trading above $8 right now with GE. Erin, Happy New Year. We're back, 2019.
Happy New Year to you and to all of our viewers. Yeah, it's great to be back. It's always nice to have a little bit of a vacation, but I missed you and I missed doing this show. I don't know about you.
Yeah, I missed you. I missed the show, missed all of our listeners. Maybe we should just stay off the air. I mean, while we were gone, the market had a pretty nice rally.
I don't know. It's pretty much a roller coaster that I'm sure I'm happy I'm not on right now.
Yeah, I actually started nibbling just a little bit on the short side on the S&P 500. I don't know. We'll see, how the market goes, but not much to make a difference. I don't know. We've had a pretty good rally. And if you remember the S&P 500, the three key levels I'm watching short term, that the S&P intraday low back in February, I think got down to 25.32. So we broke below that. The closing low was 25.81, I believe, or maybe it's 25.82. But anyway, that's a level. And then the 20-day moving average is declining and is actually right in the middle of both of those right now. I think that's at around 25.46 or somewhere around that area. So I think we're getting close. I think as the S&P bounces, I think more risk is shifting to the downside, but we'll see.
Yeah, we will definitely see. I'm not thinking it's going to be a great 2019 as far as the market anyway.
Well, did you have fun at least bringing in 2019?
Absolutely did. We had a Ducks game actually that day and went bowling with our new season ticket pals next to us. We had a great time. It was nice, just pretty much kicking back and enjoying good company. And then we rang in the new year with a couple of our neighbors, so that was nice.
Yeah, I did.
How about you? What'd you do?
Did basically the same thing. I mean, we had friends, went over to a friend's place, and of course these days, I don't know, maybe it's my age, I'm not sure. 12 o'clock just seems like a daunting task. I'm not a night person anymore, so I was asleep before the new year came in, but I welcomed in the new year when I woke up. How's that?
There you go. You probably were feeling a little better than a lot of us that rang it in really late.
Yeah, I didn't feel bad, so that was one good thing. All right, it's the new year. It's 2019. What do we got going today?
Let's go ahead and get started. We've got, of course, our upcoming schedule is strong as usual. Bruce Fraser actually is, well, I guess he'll be with us tomorrow. I'm looking forward to that one. Bruce will be Mr. Wyckoff for us. What's hot, what's not? Mary Ellen McGonigal will be back here on Friday. And then next week, we have Greg Schnell stopping by to talk about the dollar. So that should be very interesting. All right, but for today, we're going to do a farewell to 2018. We're going to talk about some of the interesting things we saw, and then we're going to go right on into what we think is going to happen in 2019 as far as the bear market goes. And we'll have our 10 and 10 to 1, as always, Nutrisystem, in honor of those getting ready to start their New Year's resolutions and their diet, NTRI. And finally, we'll finish off with some momentum sleepers. I don't know about you, Tom, but I'm trying to figure out which way the momentum is swinging on these sleepers.
Yeah, the sleepers probably don't even know at this point.
Right. All right, well, technical news and headlines. Anything out there?
Yeah, let's go ahead and jump in. There was one economic report that came out this morning. December PMI manufacturing index came in just slightly below expectations, 53.8 versus 53.9. And I think it was the China PMI that came out overnight. That really had futures spooked earlier today. They were below 50 in contraction zone for the first time in, I think it was maybe a year, or I don't remember the exact date, but I know that certainly spooked Treasuries. It spooked the U.S. futures. Treasuries gapped down. The Treasury prices gapped up. The yields gapped down. And that's an indication that perhaps here in the U.S., maybe we're looking for the same thing in time. That remains to be seen. But the last two bear markets did come with recessions. And I would suspect that if this is a bear market, we're going to see recessionary conditions take hold later in 2019. So that watching the PMI manufacturing index makes sense, and did come in just slightly below expectations this morning. As we take a look at the 10-year Treasury yield, I'm going to pull it up on a weekly basis. And let's take a look further back. I mean, this is the last 3 years, and you can see the uptrend that's been in play. And normally as Treasury yields rise, we've talked about this plenty of times, but as Treasury yields rise, it means money is rotating away from Treasuries. So as Treasury prices drop, the yields rise. You always have that 100% inverse relationship. So one of the things that fuels a bull market is money rotating away from Treasuries. We always talk about allocation. You hear a lot of the big firms, Goldman Sachs, saying that they're changing their allocation from, say, 60% stocks and 30% bonds to 65 and 25. Well, as they do that and they sell bonds, that's sending the yields higher, and it's also money available to go into equities and drive equity prices higher. So this rise off of the lows we saw back in 2016 is partly responsible for the huge move we've seen in the S&P 500. But look at what's happened here. We were actually, it seems to be a change of character. And, I always want to take a look at the other side and what possibly could look good about this. And about the only thing I can see is there was the double top back in 2016, 2017, around 260. We made that breakout in early 2018, and we haven't gone back to test it. So those who are just absolutely, convinced that that we're going to continue to go higher in 2019, one of the things perhaps they could point to is that maybe we're going to bounce when the 10-year Treasury yield hits 260. And that, of course, would result in Treasuries being sold in order for the yield to bounce. And so perhaps that money could rotate in the market. I don't know. I'm seeing so many signs that are bearish. I'm not going to put my hat just on the 10-year Treasury yield hitting a support level because, as you can see, we've hit many support levels from the past year or so, and they failed. So just because the support level is there doesn't mean it'll bounce. Anyhow, that was my look at the 10-year Treasury yield for now. I do want to say there were no economic reports out this morning, although we did get a couple of reports out, one from Tesla. We'll take a look at that chart in just a minute. But first, let's take a look at the crude oil price. Now, this does not reflect today's action in crude oil. So this is as of Monday's close, December 31st. But you can see clearly what has happened here in crude oil over the past 3 months. We've gone straight down, $77 a barrel, down into the low 40s. We've bounced a little. And with today's move, I think that the move was back up into the 47 or 47 and a half per barrel range. And as you can see, that's simply getting us up closer to this 20-day test. And we have not been able to get through that for the past 3 months or so since we dropped below in early October. Now, one positive here is that on the most recent low, you can see there is a slight positive divergence. So if we can get through that 20-day moving average, then I think maybe crude oil could move back up into this 50-54 area, maybe get a 50-day test, and then I suspect we will turn back to the downside. That's assuming, it's a big assumption, that's assuming we get up there. We may not even get back through that 20-day, something to keep an eye on. All right, as far as some of the other areas, well, of course, with crude oil bouncing today, that has definitely paved the way for energy to lead to the upside. So here is your XLE chart. But as I was just mentioning with crude oil, we got a big breakdown. We've seen a big breakdown in December, very heavy volume, and now we're rallying back up. But we're going to have some issues. If we can get through the 20-day moving average, I don't think we're going to, but if we can, then I think we've got a shot maybe to get back up into this 62 to 64 area, similar to with what I just talked about with the crude oil. A couple other areas to take a look at, the XLC. This is communication services. This was an area that was doing pretty well today also. It is up, although it is off of the earlier highs. But the overall downtrend here continues, and that overhead resistance at the 20-day is likely to be felt as we try to move higher. Within the communication services, we have internet, and I think if we pull up a weekly chart here on the internet, I think it's pretty clear we are in a downtrend right now on these internet stocks. Yes, maybe we could bounce up and test that declining 20-week. I think if the S&P 500 were to get back up into the mid to upper 2500s, I think that could be led by a little bit more of a bounce in the internet stocks. But I think that's maybe a little bit of a long-term, or not a long-term, but maybe a little bit more of a long shot as far as the technicals go. Another area within this space, and this was a group that had been performing pretty well, but all of a sudden has lost its luster, and that is mobile telecommunications. We had a double top that we had broken out from back in October, early November. We've lost that level. We're now below the 20-week moving average and struggling to get back up above it. This could be the sign of an early sign, anyway, of a more extensive downtrend in the mobile telecommunications area. Financials holding up today pretty well. And on the weekly chart, you can see posting a very nice piercing candle. So short term, we're getting a little bit of upside, which is what we would expect. I think the XLF, though, again, is going to be stretching it to try to get through 25 if we can get up that high. The banks, an area that I'm watching closely. Of course, with the 10-year Treasury yield falling so substantially in December, that's one of the things that led to a lot of weakness in the bank stocks. Big breakdown here. We're trying to rally back, but the 10-year Treasury yield isn't really rallying, so I don't think this is going to last on the banks. We'll have to watch and see. All right, Erin, I know you've got a number of upgrades and downgrades. I'll let you get to that. I do want to mention before you get into that, though, I don't know if everyone noticed, but Microsoft's market cap now has passed Apple and Amazon. And right now the ranking of the big four is Microsoft, $774 billion. That was a little earlier. Apple, $748 billion. Amazon, $745 billion. And Google, $722 billion. So we've got quite a race going on now for the highest market cap company here in the U.S.
All right. Absolutely. Very interesting news there. Okay, well, let's go ahead. We did have quite a few upgrades and downgrades. I'm going to go over the ones I thought looked somewhat interesting. All right, let's go ahead. I want to make this nice and big for everybody. All right, so here we go. So our first one is Baxter. Baxter International was upgraded by Citigroup from a neutral to a buy. I picked this one out because I think there's a possibility we're looking after this long downturn, this declining trend, we're forming what could be some a double bottom. It's a little bit complex because this bottom over here on the left is a little bit strange, but overall I'm looking at this as a big time double bottom, and we could see it break out above that confirmation area at about $69. If we get that, we would be expecting, as far as this move, we would look for the height of this pattern and add it to the top, and that I think would very easily get you up here to that $76 range. But you know, it's not a double bottom until we get the execution on it, and as I'm going to be warning, I think probably for all of this year, is to keep an eye on these 50 and 200-day EMAs. If the 50 is below the 200, it's time to start expecting bearish conclusions. So while I'm seeing this bullish pattern, the 50 is below the 200, meaning that Baxter is in a bear market configuration. So you need to keep that in mind. And like I said, I'll be reminding you as we go along, at least into the next month. All right, next one up, CBS. Stevens upgraded it from an equal weight to an overweight. I like the setup on this chart, I have to admit. You've got a PMO that has gone into deeply oversold territory. It's starting to turn up with this breakout to the upside that you can see in the thumbnail that came up above that 43.50 area. We got that break, and now we are starting to head up, and I like the setup of the PMO and the OBV, but again, 50 is well below the 200 and it is still on its way down. So just be aware of that. I would say looking over here to the left side of the chart, your area of overhead resistance, the next one is right around that $47 area. Or even up here to the $49 area. So that's where I would be looking for possible resistance in a downturn. And of course, always keep an eye on that PMO. If it flattens out or turns down, that's warning to you. All right, MetLife was upgraded today from a hold to a buy, and nice setup on this chart. We've got the PMO buy signal that has come in. I'm noticing rising bottoms on the PMO here and declining bottoms on price, and that would be considered a positive divergence. So we should expect some upside movement. The only issue I have right now is just above $42 as we have these lows, and that could very easily pose difficult overhead resistance, and you can see it also lines up here at that 42.50 range with the lows we saw back in May and in July. Next one up, Wells Fargo was upgraded today by RBC Capital from an underperform to a sector perform. So not a real big vote of confidence here for Wells Fargo, just moving it to a perform. And I have to say, in the sector it's in finance, that sector isn't performing so well. So I'm not so sure being a sector perform is all that great here for Wells Fargo. But in any case, I think the chart looks fairly good. You've got that rounded bottom here on the PMO in oversold territory, coming up hopefully for that buy signal soon. And the next area of overhead resistance, $48, $49 right here, 49, maybe even that $50 range. So there is some potential here to ride out a little bit of upside momentum. But with all of these recommendations, well, I wouldn't call them recommendations, but for any of them that I'm looking at in a bullish fashion, like I said, just remember that we are in a bear market configuration just overall. And so I would be considering any investment at this point. I think Tom and I were talking, well, Tom, we were talking about it earlier, that at this point, you really have to have your hand on the wheel. You really want to be watching and consider most of your upside investments as short term. You need to keep an eye on them because of just the situation overall. You can see the PMO is turned down below the signal line here for Hologic. This one was downgraded by Morgan Stanley from an equal weight to an underweight. Not looking good, although you do have some very important support it's getting ready to test. And if that can hold and you get that PMO to turn back up, could be an interesting play just in a trading range. Louisiana Pacific, a transport here. We don't want to see them doing too poorly at this point. And today we got the downgrade by B of A Merrill from a buy to a neutral on Louisiana Pacific. It is coming down to test really important support. But, you know, we're looking at an over 6% move to the downside, not something you want to see. However, like I said, maybe worth a watch list to see if that PMO can turn itself back up. But you're seeing declining tops on the PMO, declining tops on price. That's really a bearish confirmation. So might be worth a play. Like I said, get it down to the support level there at about $20. Might be able to get a couple of percentage points out of it to the upside. All right, final one I have for you, Weyerhaeuser. This one was downgraded today by B of A Merrill as well from a buy to a neutral. It's also coming down to test some really important support. But Weyerhaeuser has been in a declining trend for quite some time. And, I'm going to show you some charts later. It's kind of, I don't know, deja vu GE kind of setup here. You're getting these stopping points. You can see that all along the way, but they are not amounting to much of anything. And you can see we had the low in the thumbnail. It's managed to make its way back up, but now it has fallen right back down and the PMO is turning down. It is oversold, but I would expect to see that. So, all right, upgrades and downgrades. Like I said, a couple I didn't go over for upgrades: Caesar Entertainment, Crocs, Estee Lauder, Shoe Carnival, SiriusXM, Viacom, all of those were upgraded today. And as far as other downgrades I didn't cover, Abbott Labs, Aflac, Medtronic, Novartis, and Vertex Pharmaceuticals were all downgraded today. All right, I guess that brings us into our next segment here.
Yeah, we're going to look back at 2018 and, I don't know, just reminisce a little bit what happened in 2018. And as we head into 2019, we'll talk a little bit more about 2019 in a few minutes. But as you look back over the last year, what really sticks? I mean, what some of the things that stood out?
Okay, well, I'm going to get my DP scoreboard summary up here. Give me just a moment. I want to look at some of the DP signals that came through over time on our DP scoreboards, just to give everybody sort of a feel for what I've been seeing here as far as scoreboard changes. So I want to get that up and running here. All righty. Okay, so hopefully you can see this. This is actually my summary, and you can see I basically build off of them. So I can see, I'm going to go back here. You can see I go way back here. I've been tracking our signal changes for a very long time, and you can see how, we get those changes in the arrows as you go along, just in a basic way. So this is all the way back from 2017. So I'm not going to go from all the way back there. I think we are here now, almost there, right? In here, almost. There we go, 1128, 1129. So you can see how these signals have been playing out. Okay, so I'm going to just start. We'll start here at the December 5th. But what I want you to notice over here, I'm going to actually make it a little bit bigger because this is the important part of this, if I can get it bigger. Well, I guess that's as big as we can get it. So I'll just bring it over here where it's a little more obvious. So anyway, I just want to give you sort of the overview. We don't need to look at each signal. I just want to show you where we've come as far as the green arrows versus the red arrows for our sell signals. So if you look over here, the first set of arrows are our trend model signals in the short, mid, and long term. Those are determined by the setup of the EMAs on our daily charts. So 5 and 20-day crossovers are the short term, 2050 are midterm, and the 5200 are the long term. So I just wanted to show you as we went along here on the left. And you can see we started to move to a point where on January 5th of last year, so we're talking a year ago, we are seeing all green scoreboards. So we started off this year very, very strong. And of course, if you recall, that was right at the end there when we started that January move. We kept going. It was very parabolic. But then we hit February and we had that unbelievable decline. And now you can see after that point, all of the signals, all those green arrows disappearing. And then we had managed to see them come back at the end of February for the shorter term. But overall, you could see that while we bounced around, we spent a lot of time with not green arrows as the majority of those scoreboards. Here you are in March. We've now moved and we have even more red and neutral signals here, and it just keeps going. And what I want to show you is whether did we ever get really back into that all green space? We really didn't. just arrow down. Like I said, there's a lot of these signal changes because I marked every single time. I just keep updating it just so I have a really good history of what's been going on. And you can see here we are in May, and we're still getting more of the negative signals as they're coming in. We had that little bit of a move to the upside. You know, the NASDAQ did find its strength there mid-year, and you could tell that by just looking at what's going on with that scoreboard. And then for a while, we were looking at the Dow being the leader. So let me go down here. I'm just going to move it a little further down. So here's where we got back to a lot of green. That was back in July. And like I said, you can really follow. Look at this. We're back to almost all green scoreboards here. Look at that. The only one we had left was that Dow midterm signal in the red. And that's what's really been happening, what happened to us at the end of the year. So I'm just going to move all the way back down. Because what we were watching for, what I had been watching for, was this 1230 signal right here from 2016. It had been the only buy signal left on there all through December. And as I will show you, it was only a matter of time. And we did the very end of the month, when these signals do go final, we found that the PMO on the monthly chart did manage to move below the signal line. And so now we have completely red, with the exception of these intermediate term neutral signals. And the only reason they're neutral is because when they had their negative 2050 EMA crossovers, it occurred above the 200-day EMA. And that means that the 50 was above the 200-day EMA in October when these started to trigger. And so that means that you're in sort of a bull market configuration, right? When the 50 is above the 200. So rather than going into a sell signal, we choose to go neutral. And so as you can see, to finish up 2018, we went from a January where we had all arrows that were green in January of 2018, and now we're looking at scoreboards that are completely negative to the opposite side 1 year later. So I thought that was very interesting. And I'm going to just show you a few charts here, and then I'll give you your shot. I want to show you just a couple of the weekly charts here. Here's the Dow's weekly chart, so we can really get a feel for what was going on in 2018. And as you can tell, I mean, really, after we hit that January, we had that parabolic move to the upside. And then at the end of January, February 1st, we got that huge decline. And really, since then, it's just been a rather volatile, difficult trading for the year. I mean, you could come in here at that low and manage to get back up to the top, but you know, the timing of it has been very difficult, as you all know, as you've been watching the show. But what I want to point out here on this weekly chart, just to be keeping in mind, as far as 2018, we lost some major support here on the Dow Industrials at 23,500. And I don't think we're going to recapture it. Right now, we have an opportunity to get back up to where we saw these lows. But looking at that very ugly PMO on the weekly chart, I'm not seeing any deceleration, and you can tell that we are not really in oversold territory. We can see much further readings to the downside. I mean, look at where our top reading was here, was at 5.5. So I would say that typically, though, you're only going to see these move between 2 and -2 typically. And you can see when we moved parabolic, that's when we got the PMO that really extended itself into very overbought territory. It was really just a matter of time. So that's what I wanted to look at as far as 2018. The fact that in January, we were in all green, all buy signals, Tom, and now we're completely on sell signals with a few exceptions of neutral signals. So not a good year. And I'll talk more about what I'm looking at for 2019 after you're done.
Yeah, it wasn't a good year. It actually, really turned. And I was pretty bullish up until things began kind of deteriorating in the fourth quarter. But it started off with a lot of volatility, which is something we didn't have at all in 2017. So I'm going to start first by just looking at the VIX. And this is a 20-year monthly chart. And the reason I'm pointing this out, I don't have the S&P 500 on here, so you just have to take my word for it. But back in early part of 2000, the volatility index here shot up to 34 on the first breakdown. In other words, we had created some lows, we had some price support in play, and when that price support was lost, the volatility index shot up to 34 and marked a near-term bottom. Quickly, we put in another short-term bottom in the VIX, and then we rose back above 30 once again on the VIX, and that was felt when the S&P 500 took another drop. Fast forward to 2008, we saw something pretty similar, where the initial breakdown in the S&P 500, that bear market breakdown where we start to put in lower lows, took place with the volatility index hitting 37. When we pulled back within that next week, within that next month, the low that we saw was down around 22, and then the VIX had bounced back up into the 30s over the next 2 months. We actually got back up over 35. So when we hit this volatility index recently up at 36, 37, I figured we were getting close. I wrote about it quite a bit in my blog that we were going to bounce. It was just trying to get the timing down the right day, because you could be off by a day and it could cost you a lot of money. But we did get that bounce. You can see the VIX now has come back down. I think we're getting that first pullback like we saw in the last two bear markets before we get one more surge. I think the VIX is going to surge again one more time, probably into the lower mid-30s. It'll come with another scare. And then I think the market will settle down. And these black arrows show you that the next time when we settle down, the VIX will probably move back down below 20. And in that move, I think that bottom on the VIX is probably going to create the best shorting opportunity with the least amount of risk. We're not there yet. I think the first quarter of 2019 is going to be very interesting because the volatility picture has changed so much. But this is, and again, we're looking at the last two bear markets, not a huge sample size. Market can do whatever it wants. But from a common sense perspective, when you get a volatility index up into the mid 30s or close to 40 or even above, everyone's panicked. I mean, that's not a rational market. And so anytime you get an imbalance of orders on the sell side, and that's what happens when you get a volatility index up where we've seen it in the 30s, mid to upper 30s. Anytime you see that, that generally is going to mark a very important bottom in the stock market. So the S&P 500, the low that we saw before this latest rally, is going to become very important. I think it'll be broken in time, but I think it'll probably hold the next time we go down and revisit. And so that'll be worth watching. So I think the first thing that changed to me in 2018 was the volatility. Look at 2017. We never had a VIX reading above 17 and change, not one the entire year. And it's because the S&P 500 barely pulled back. Another thing that changed, I think, in the market in 2018, the Treasury market. Everything looked good. We had the huge run up back in 2016 in the yield. And as a result, we just kind of consolidated that in 2017. And then we finally broke out. And I was looking for the 10-year Treasury yield, I'll be honest, to move up to 4.5%, because I believed a lot of what the Fed was telling us. I believed what the market's been telling us as we were breaking back out the new highs. But a lot has changed in the last 3 months. And that's really the biggest, well, maybe the volatility coming in was the biggest surprise at the beginning of the year. But maybe a close second was how badly many areas of the market performed in the last 3 months of the year. Look at the 10-year Treasury yield dropping from 325 back down to 266 right now. This has all occurred in just the fourth quarter and one trading day so far this year. That's a huge move down. And while you could look back and say, well, we did something similar in 2017, we did so after we had a huge run up. Here, we're actually taking out all of these prior lows. I don't like what the Treasury market is telling us. Then we go in and we take a look at some of the aggressive sectors, the XLK versus the S&P, the XLY versus the S&P, the XLI versus the S&P, and the XLF versus the S&P. So we've got technology, consumer discretionary, industrials, and financials. And I want you to, during a bull market, what you normally see is money rotating in risk-on fashion, meaning money rotates into aggressive areas of the market. And I think for the most part, you're going to see over the last 10 years that these relative ratios, with the exception maybe of financials, which struggled coming out of the bear market of 2007 to 2009. I mean, this was certainly the area that everyone was concerned with. But for the most part, we have been bouncing and these relative ratios have been rising. That has changed here in 2018. And, even through midsummer, I was thinking, okay, we're still looking pretty good, especially technology was still strong. The consumer discretionary space was still strong. And it wasn't until about September that we started struggling and technology took a turn. Industrials and financials have been weak on a relative basis throughout most of the year. And some of that you could attribute to the recent weakness in the 10-year Treasury yield, but that was not the case earlier this year. So they were already some warning signs, and now technology's adding to them. So I think that was another big change in 2018, especially in the fourth quarter. Looking at small caps, nice uptrend in play. Everything looked great, and then we just literally fell off a cliff at the beginning of October. And you can see the movement down here. And the only thing that I've seen from a technical perspective, maybe I shouldn't say the only thing, but one thing that's really stood out that happened in October is when we look at the German DAX. The German DAX had been moving up higher, just like U.S. market, throughout the entire bull market run. It topped, put in a double top at the end of 2017, early 2018. And then when the S&P 500 kept going higher in 2018, the DAX did not. So we put in a little bit of a negative divergence between these two indexes. And why is that important? Well, if you go back and you look at the correlation, and this goes back more than just the last 10 years, but the two indices, the German DAX and the S&P 500, are as positively correlated as any two indices that I've reviewed, at least relative to the S&P 500. And now they're both going in unison to the downside. As you can see, the correlation is back near 1%. The DAX is going down, the S&P is going down, but the DAX broke back in October a head and shoulder formation. Left shoulder, neckline, head, neckline, right shoulder, breakdown. This measures down probably another 800-900 points. And so while we might see a little rally from time to time, I don't think the DAX has seen its low, and the correlation between the DAX and the S&P is likely to continue to push the S&P 500 lower as well. So those were some of the areas. A couple of others that I didn't get into the charts, but the transports, the railroads especially, also suggesting things really changed in the U.S. in the fourth quarter. So those are our farewell 2018 topics that we covered. And now we are going to go into the depths of the bear market. And so looking ahead, what do we see? What really stands out to us? What will we look for? Erin, what are you looking for as we head into 2019?
All right. Well, let's go ahead and I'll get my screen here ready to go. All right, so I thought I'd look at just a couple of the monthly charts just to give everybody an idea of what I am looking at as far as what's going to happen in 2019. Kind of the, I guess the milestone markers is what I'll be looking for going into 2019. I do believe that we are in a bear market. I do believe that we will see most of 2019 overall, we will see a declining trend. What I'm watching right now, and you'll see on a couple of these monthly charts, is we do have a rising bottoms trend line that's actually held up. I mean, honestly, it only has the two touches, but all it has to have is two touches to be official. And when I look at these rising bottoms trend lines, right now the Dow is okay. The NASDAQ, I believe, is okay. And if we look at the OEX, not so okay. This one, we already did see that breakdown. And now we're trying to come back up, and we're not able to get over this resistance area at the lows back here from 2018. And like I said, we've already, we busted down below that rising bottom support line. The good news is that we did close above it. So, barely, but we did. And so now what I really am looking toward is whether we can get back up above that. But that's the OEX. And of course, what's the most interesting to everybody? What do we always follow? The S&P. So what are we looking at here right now? Okay, so like I said, I do believe we're going to be looking at more downside. I don't have the rising bottoms trend line drawn here, so let's go ahead and put that in so we can get an idea of what we're looking at. And we will make it red. And I think we'll start down here. So I'll get back to it. so I want to draw from, yes. Oh, it's taking a while here. All right, so yes, so you can see the S&P, we've lost that rising bottom support. Again, we closed just about on it, but right now we're trading below it. I went ahead and put in the Fibonacci retracement lines because really, and I think I showed this to you all before we left on the break, and it just lines up so beautifully as far as the support and resistance levels that I just couldn't resist it when I put it on. And so now what that is telling me, where am I looking for our next signpost, our next area of support? Well, when I look at the Fibonacci tool, I would be looking at that 2150 level. That's, you know, the next stop. I don't know that that will be the final stop at this point. We may need to go all the way back down here to the 1800 level. And I think I talked about that again before we left on the break as one of the levels I'm looking at. So 2019, not looking quite so good as far as I think the price charts are looking. And then I'm going to just look really quickly at our intermediate term indicators because they will give us a little bit of an idea, at least going into the front half of 2019, maybe what we have to look forward to or not. I like the look of my intermediate term indicators right now. They've been pretty much on a downside swing for, you know, most of December. And we got the turn, and we're starting to head back up as far as the PMO is concerned, and as far as both of these indicators. They've been in very, very oversold territory, and like I said, they're finally turning up. Now, we do get a lot of false starts. We get some that are fake outs. We get some whipsaw, but right now, I think these lows look really promising. I would look for them to start rising, in which case we could start to see a little bit of a comeback bounce. And I suspect when we get that, everybody is going to be shouting at the fact that the bear market is over. I don't think it will be, but we are due for a pretty decent bounce. We just got one. I think we're going to find some consolidations. We try to get above that overhead resistance at that 2500, 2525 level. I think we will be able to bust up through that, but I'm really not looking for a move much past 2600. If we get any kind of a bounce, just don't fall for the hype would be my parting words as far as 2019. Don't believe the hype.
All right. Is that it? You got?
Yep, that's going to be it for me. So how low it can go, honestly, I seriously could see lows down into the 1800s. For the S&P. I don't want to see that, but 2150 seems highly likely.
Okay. I'm not going to totally disagree. I don't think it's going to go down the 1800s. I'd be surprised. I think things would, I mean, it's hard to tell. Things will unravel, and we'll kind of get a better sense as we go on throughout the year. But my initial sense is that I don't think we'll go back that far. One thing I want to say is that for me, I believe that this is a cyclical bear market in a secular bull market. And so here's a long-term chart of the S&P 500. I'll kind of hopefully explain some of what I'm looking at. First of all, you have to understand that the stock market goes up more than it goes down. We do tend to increase our gross domestic product over the years. Yes, we go through recessions. Yes, we have periods of times when it's very difficult. And this is a chart on the S&P 500 dating back to 1925, all the way up through 2018. And what you're going to see is that we go through periods of secular bear markets where the stock market is just stagnant. You're probably not going to make money during extended periods of time. We saw that in the late 1960s, throughout the 1970s to about early 1980s. You could maybe point to 1980 or 1981 with this breakout, or maybe after this pullback with the next breakout. But I think from there, you can see that we kind of left that prior secular bear market in the dust, and this became part of a secular bull market. And when we got up to, and this lasted, by the way, depending on what dates you want to use, anywhere from maybe about 17 to 20 years. And if we go back, by the way, to this prior breakout in 1954, this lasted, depending on where you wanted to draw the top, anywhere from about 15 to 19 years. So about the same amount of time. We had bear markets, by the way, in these runs to the upside. I didn't circle them, but they are considered cyclical bear markets within a secular bull market. So the longer term uptrend is in play, but these pullbacks can be nasty. They can scare the heck out of you, but they're more shorter term in duration. In other words, once you get through them, the prior secular bull market takes over and you march to new highs, as opposed to these red shaded areas where you don't break out the new highs and it's just a lost decade or even longer. Here you can see this one was about 12, 13 years. You go back here from, I don't know, maybe the late 60s through the early 80s. Again, probably around a dozen years. And then we make the breakout. So if you look at this, if we're saying that we just broke out above the prior tops in 2013, then we're only about 5 years into what I think is a secular bull market. And when you look back, and we had some pretty big moves. If you look in the early 80s, anybody who thought, okay, well, this move to the upside's been way too overdone and maybe got scared by that 87 crash. 87 crash was a big deal back then. On this chart, it looks like a blip on the radar. But they're still scary. When you pull back, they are still scary. I think that we are in something similar to what we saw in the 80s and 90s. So when I look at this chart, I was like, okay, yeah, we got ahead of ourselves. I do think that we could see more downside here. I expect more downside in 2019, but I don't think this is going to be the type of bear market that we had in 2008, where we had a financial system meltdown and the S&P 500 dropped 60%. That is not the normal bear market. That's a pretty serious decline that we haven't seen in our history very often, maybe with the exception being back in the early 1930s with the Great Depression. So a more normal type of a bear market, I would say, is maybe 25 to 35%. And so from 2,900 down to, or was it 2,800? I can't even see it on this chart. I think it was 2,900. But anyway, from that, if you take 30% off, you're talking about maybe 800 or 900 points. I think that the breakout that we saw, and I'm going to shorten this chart now so that we can get a better view of what happened here recently. But I think this breakout right here in the consolidation that we saw in 2015, 2016, and then that breakout was at about 2,100. And I think that would be a more normal bear market. So I'm not going to be surprised if maybe we make a push back down at some point in 2019 for 2,100, maybe between 2,100 and 2,200. So that's really what I would be looking for. It's going to be volatile. Obviously, volatility is already high. So it's not going to be an easy market to try to trade in. I think you're going to have to really be patient to try to get the market on your side, whether you're long or short. Like even right now, I think the market could go a little higher. I think the S&P could have another 50 to 70 points higher here in the short term, but it also could go down 150 and retest the recent low. So it's just going to be a difficult type of a market to trade. I think in 2019, perhaps the best asset class, I think Martin Pring just wrote an article in the blogs area, but I think it could be gold. And I was not a gold fan in 2018. I'm still not quite sure what to make of the dollar. I think with the 10-year Treasury yield dropping so rapidly, it's telling us that the U.S. economy is dropping rapidly as well, slowing rapidly. And as a result, I think that could have a negative impact on the dollar. And if it does, I think that could give traders two reasons to go into gold. One, being a falling dollar, and two, just the safety net if the S&P 500 continues to fall. So whereas I'm not a very big fan of hedging with gold, especially during bull markets, I would be perfectly content and okay with hedging with gold in 2019. Even if the bull market somehow mysteriously resumes to the upside, I think it's worth the risk of having gold as a hedge in 2019. Last chart I'm going to pull up, and I'm going to do a weekly chart on this. I think I've pulled this up before, and we're going to go back maybe the last 25 years or so. I'm going to pull up a chart of the jobs data, and I think you can do that by putting in $, EMPLOY, $, employ, and I'm going to change the RSI down here to rate of change, which is 12, so 12 months. And then let's update. Actually, I want to make this a little bigger so we can see this rate of change on the chart. But here is one problem, and maybe this is the silver lining for the bulls. If you notice, the jobs data continues without much pullback at all to the upside. Rate of change is still positive. One thing we saw back, remember, the bear market in 2000 started in October. The rate of change began dropping earlier than October of 2000. You can see it really dropping. Same thing in 2007 into 2008. The rate of change in new jobs from the jobs report was declining before we topped. Here, we haven't seen that yet. So if there's one piece of silver lining that I think the bulls could still point to say, this is a major, massive head fake to the downside, and the economy's still strong, and if that's the way you want to go, this is the one chart that I would point to. So I said in my blog this morning, I was thinking about it anyway, Friday is going to be a big day because we do have another jobs report coming out. If that jobs report is weak, then I think what you're going to begin to see is a dropping in this rate of change in terms of job growth. And that, I think, would confirm what we're already seeing in so many areas of the market. So this is something I would watch really closely on Friday. I don't think this is just any other jobs report. I think if this is a weak report and we begin to see a little deterioration in the jobs market, that could be further confirmation of what we've been seeing on the charts. I know Erin's been talking about it for months, that she thought it was a bear market. For me, bear market correction, I trade the same way for the most. Well, that's not true. I'll shorten a bear market. I won't shorten a correction. But to me, the risks are extreme in both. Until we officially get a breakdown, I don't view it as a bear market. I have to see that price breakdown in the S&P, which we did see below. If you're using closing prices, 25.81, 25.82. And if you're using intraday prices, it was 25.32. But both of them went easily to the downside. We have a lot of confirming technical evidence that supports a bear market at this point. So anyhow, that's a synopsis. I know just kind of a really big overview, and we'll be talking about 2019 throughout the year on the show every day. So definitely you're going to want to check in, read the blogs. We have a tremendous amount of talent that regularly blog, and we'll give you different perspectives. We all don't agree, and that's fine. I actually love reading the other blogs sometimes just to keep me grounded and to make me think about what maybe someone else is seeing that has a lot of experience in the market. And I think that's a good thing. So stick with Stock Charts 2019. We're going to help you through it. But right now, Erin, I agree with you. I think it's looking like could be a rough year ahead.
Yes, I'm afraid so. Now it will be trying to figure out how to trade. How do we take advantage of the different areas of the market that maybe are going to do well, but also mitigate our risk. It's going to be very difficult. And like you said, stock charts, bloggers, Market Watchers Live, all of our shows, hopefully we'll be able to help with that.
Yeah, I mean, I know that's part of the vision that Chip had when he started Stock Charts. Not just the tools, which are extremely important. And if you're not a member, you should become one in 2019 and really change your financial future. But it's also the education and the commentary that are very big. And I think Stock Charts TV just kind of fits right in like a glove into his vision for Stock Charts going forward. 2019 is going to be much different than 2018, and certainly a lot different than 2017, where we had almost no volatility. I expect in 2019, I will be sitting in cash a lot more than I have probably since 2015 into 2016.
Mm-hmm. I know that's the case for me.
All right. Well, it is time, I guess, for our first 10 in 10 of
the year. Yes. I have the RRG ready. I'll just show it real quick.
Okay, we're good.
Get yourself together. All right. So here are what we have. I actually took out Erin just because it's such an outlier. It's way down here. So I took it out just so we could see these a little bit better. I thought it was really interesting that everybody's requests did tend to be in the leading category. But as you can see, all those leaders that we were seeing earlier are now turning back around and could be showing some, a lack of leadership or weakening. But we do have a couple of interesting ones here that are moving in that northeast direction. So we'll see if we can look at a few of those. But let's go ahead and get started with Nutrisystem. And I did see a note in the chat room that apparently it is being looked at for a takeover or to be purchased. So the chart might look a little weird.
Okay, well, it did have a big gap up. I'm not aware of that, but it's hard to keep track of all the stocks. I think that right now it's in a range. If it was bought out I don't think it was a cash deal. If it was a cash deal, we'd pretty much just see a straight line going across here. So if they were being bought out, if this was an announcement of a buyout, they're probably trading alongside or with another company, whoever bought them out. I apologize for not knowing that, but I just don't recall anything on Nutrisystem. But technically, the two areas that I think are most important to the upside, $45 is your resistance. That's where we gapped up. I don't like that black candle after a gap up. That normally tells me that from the open, bears, market makers, or whatever, are able to get control on the short side. So that tells me that we're more likely than not going to go lower. But here was that prior high, and you can see we did bounce off of that support level. And then finally, we've got the 20-day moving average, which is rising, coming up underneath price. So I would say your resistance is right now at about 45, and you've got some support between 42 and 43 to the downside. If we lose the 20-day, I'm thinking maybe this double top down closer to 39 could come into play. So kind of a mixed picture here. I mean, obviously the stock's done very well relative to what the market did in December. So that's a good thing. But I would still watch these key technical levels.
All right, interesting. The most popular in the chat room, interestingly enough, is General Electric.
Yeah, GE, this will be interesting to see how it closes today because we haven't had a close back above 8. And I think there are a couple of areas to watch on GE. I think 8 is one level that we want to keep a pretty close eye on. I mean, you can see on the move down, we bottomed at 8. We had a big bounce on heavy volume back to 9. We migrated back down toward that $8 level and then failed. And then once we failed, look at all the tests trying to get back up through 8 without any success. So the first key thing that the stock needs to do is close above $8. It's at 809 today. Volume is already 80 million shares, just past the halfway point in the day. So it's going to be a pretty strong volume day. So the close will matter. I think to the upside, we've got to watch that reaction high at 9. If we break above 8, I think we could trade in this 8 to 9 range. Or maybe I would probably go down to that rising 20-day moving average. So maybe 7.5 to 9 is what I would be looking for. So here you can see we made the break above the 20. See how the last time we broke above the 20, we failed. This time we're holding. So the 20 is starting to turn up. The PPO is rising, although it is still negative. I think this area could be consolidation for a period of time, which could be a good thing for GE. So I'm turning a little bit more bullish here. I think it's still got some technical work to do. Stock did fall a lot, so got to give it a little bit of room back to the upside, just a normal bounce. But I do think things are beginning to change a little bit here with GE. This will be an interesting year in 2019, I think, for General Electric.
All right. Let's see. Next one up, also one of the most popular, the ProShares short for the S&P 500, and that is SH.
All right, SH. Well, this is one way to, if you believe that we're in a bear market and you believe that the S&P is going to go lower, then the SH is a great way to benefit from it because you trade on the long side. You're not shorting the SH, you're buying the SH. But the performance is inverse to the S&P 500. So when you're buying it, you're going to make money if the S&P goes down. You're going to lose money if the S&P 500 goes higher. So just remember that there is definitely a 100% inverse correlation between these two. The SH, I think, is a great way in a retirement account. If you want to benefit, if you believe we're going down, it is acceptable to buy the SH in a retirement account, whereas retirement accounts, typically you can't short. But the SH, some of these inverse funds do allow you to essentially short in a retirement account. Now, the SH, as it pulls back, I think obviously your reward to risk begins to grow. If I annotate, we had clear tops at about 30, which I'm assuming probably comes in pretty close to that 25, probably would be somewhere close to that 2580 area on the S&P 500. So in other words, if the S&P continues rising and gets back up to 2580, I would think you probably see the SH back down close to this support level. And that would be the better reward to risk entry into the SH. If you're thinking about it here, I would just simply, because I don't like to be real aggressive on the short side. If I lose money on the short side, I don't want to lose a whole lot. So if I was shorting here, I would be adding to it perhaps as it gets down closer to 30. So use the strength to build a position and then draw your line in the sand and stick to it. Even if it means you get whipsawed out, I would stick to it, because if the market does take off again, you don't want to be sitting there holding on to an inverse ETF like the SH.
All right. That's good advice. Okay, so let us go to WDAY, WDAY, Workday software.
Yeah, Workday was one of the best performers, and still, I think, one of the better performers in the market. It had a great report back here at the end of November, shot up above 170, came all the way back down, tested the 50-day moving average and gap support, which was at 145, before turning back to the upside. I think right now it's in a trading range. And if the market overall, if we're in a bear market, it's going to be difficult for many stocks to perform well. So I think maybe even, well, I'm going to draw that recent low. I think there's your trading range right now on Workday. So it's better than most stocks, but I'm not going to be overly bullish. And in fact, if I was in it and it got back up close to 167, 168, I'd take my money and see if it can close above 170. I would not be assuming that we're going to take out resistance. I know Arthur has written a lot about this recently, that the game changes, and instead of assuming that price resistance gives way, you want to actually assume that price resistance holds and that price support gives way in a bear market. So WDAY, I think, looks pretty good right now. Look at it in this trading range. I'd sell near the top. I don't know that I'd buy on a way back down toward the bottom. I'd have to see what the overall market looks like at that time.
Okay. Let's see. How about FMC as our next one? FMC Corp, Specialty Chemicals.
Don't like it. And this is the way I'm going to view most charts. I mean, nice bounce, that's good, but less volume, big volume on the way down, lighter volume on the bounce back. It is getting close to the 20-day, but it's also testing overhead price resistance, where many times we will see failure. So right there was prior support. And then if I put in here the 20-day, which I suspect will probably hold as resistance, I think 74.5 up to about 75.75 is the area of resistance on FMC. So as it moves into this area, if I did anything, I'd be shorting.
All right. Let's see the next one I'm going to give to you. Kronos. I think you're familiar with that. CRON.
Yeah, I think we've looked at it a time or two. Nice move on the stock, by the way. This is one of the better stocks, I think, in this cannabis space. The double top coming across here at about 14, the low in between all the way down at 6.5. Obviously, we have a very volatile stock, but I think we're going to go back up and challenge the high. I like the volume trends here. There was your top. You can see clearly that is resistance. To the downside, maybe use that recent low or even the 50-day moving average. But I would draw it right there at that prior candle body low. I think we're in a trading range. Beautiful day today so far. I think in time we go up and test that 1375 area.
Okay. Let's see, next one I have for you. The Brazilian shares, I guess, the ETFs are going crazy. We had two requests, but let's go ahead and go with EWZ, the iShares capped ETF.
All right, that is Brazil. Yeah, this chart I think looks pretty good. And you got overhead resistance. So I think from that standpoint, I'd probably be a seller as we get close to resistance. But keep in mind, I am a short-term trader. So anytime I have an opportunity to walk away with some profits as it hits resistance, that's what I would do. I think your gap support down here, big gap up back on October 8th. That has held on recent lows. So that's the area I'd watch the downside. But yeah, I'd sell up close to 41 until we get a confirmed breakout above that level. And if we pull back, get down close to 36, 37, I think that is the area where we will likely see buyers return.
Okay. Next one up, AMD. What do you think of the semiconductors?
I'm not a big fan of the semis. Got a lot of work to do. AMD is testing its 20-day moving average. It has really struggled there for the most part in the fourth quarter after falling below. You can see this drop actually back at the beginning of October. Every test back up there has really been a struggle, except right at the end of November when we got up to the 50-day. But we've moved back down again. We've tested the support level. There's no doubt 16 is a major support level at this point. I think if you go back and you look at the gap up on big volume all the way back in September, that came from 16. We went all the way back down off the heavy selling we saw in October. We bounced at 16. And then just last week when the market rallied, we rallied off of 16. So if you own the stock now, I would not want to see it close below $16. To the upside, you can see all the failures that have been occurring at that 20-day moving average recently. So what you want to see from a long perspective is simply a breakout above the 20-day. If we can get that, I think we got a little bit more room to run. 21 would probably be the next key area of price resistance. And then maybe if things really are good for a little while in the first quarter, perhaps we could get back up to the 24 level. But I would be surprised.
Okay. Let's look at Disney. DIS.
All right, Disney I looked at not that long ago was actually still pretty bullish on the stock. But let me see. I don't know if I looked at it after we had the huge drubbing. I didn't see all that. We broke down below 108. I thought that was a key support level. We've gotten up just above the 20, and now we're back down below it. I think we're in this no man's land right now trying to figure out whether the stock wants to resume its prior uptrend. I think this area, we need to figure out which way we break from it. But we had a series of higher lows in play from last week. What was that? That was last week, last Monday on the Christmas Eve. So here you can see we've been putting in higher lows every day. That is still holding. I think if we fail to hold the low that we saw back on Monday, I'd be a little bit more concerned with Disney. But here in the near term, I'm pretty concerned just because we're back up into a key area of overhead resistance in a market that I'm feeling a little bit more bearish about. So I think Disney right now is a sell for me. If it could break out and close above 110, get some volume in, I think things might look a little bit better. But till then, I'd be cautious here.
All right. And our very last one from Consumer Discretionary, Signet Jewelers, SIG.
Yeah, I had a feeling this was not going to be a very good looking chart. Big gap down back in December. I think that was earnings related. It lost a pretty key area of support at about close to $50. So up above, obviously, they're going to be two big levels. And I don't think we're going to see those for quite some time. But those are the key levels, your top and bottom of gap support or gap resistance. We continued selling off. I believe the first test of the 20-day is likely to be a failure. So I think if we get back up near that 35.5, 36 level, I suspect that we are going to turn back down. Yes, we've rallied nicely, but it's on very light volume after a huge move to the downside. I think the stock is pricing in a recession in 2019. I think that's what a lot of the market is pricing in. So another one to be cautious about. Watch that 20-day moving average.
All right. That completes the 10 and 10. Here are the symbols that we looked at. I will have all of those charts that Tom just annotated up in the Market Watchers Live chart list. If you'd like to go there and copy the charts or use them however you'd like, just go to the blogs tab and you'll find the Market Watchers Live blog there. Click on it and the link will be right there at the top, as well as in all of the recap articles that I do put up there. All right, time for our final market update. Let's go ahead and see what the market has been up to. And we actually have a little bit of good news. Whoops. All right, the good news is, yes, we are now starting to see prices on the upside for the major indexes. We could see that in the last 10 minutes, Dow Jones has moved itself back up into positive territory, up about 58 points currently. S&P 500 also managed to wend its way up above and into positive territory from last close on Monday. You can see NASDAQ also moving into the positive. Mid-caps not quite there yet, but certainly on their way back up and could manage to get above and into the positive territory by day's end, Russell 2000 is back in positive territory. You can see it took a dip there for a little bit just after lunch, but now we're moving back to the upside on the Russell 2000. Not quite to those intraday highs, but trying to get back up there. TSX, Canadian markets, also up right now. Started out the day down quite a bit with a big gap down and managed to make all the way back up into positive territory. And now the TSX is up just over 68 points. TNX Treasury yields are mostly unchanged. We are down right now, currently reading 2.672%. Volatility index is falling, but we are still above 24, reading 24.17. UUP, big gap up, and the dollar is continuing to rise here as far as UUP. Gold, we had a nice move to the upside, but you can see an intraday double top. Looks like we've now executed that particular pattern, and that would actually suggest that we'll come down and test the intraday lows from Monday. We'll have to see if that comes to fruition. USO, really big drop to the downside on the open, managed in very quick fashion to get back into positive territory, and now has formed a pennant on possibly a flagpole here in the very near term. Currently, USO is up 3.62%. TLT on the positive side, up 20 cents at 121.71. And that's all I had for our final market update. What you got for us, Tom? I am not hearing you.
Oh, sorry
There
about
you
that.
are.
Yeah, volatility index I wanted to just kind of talk about here for a second, because we have now seen a fifth consecutive day of moving lower on the volatility, and that's always bullish for the market, especially coming off of those extreme levels. And I mentioned in one of the earlier segments how the VIX, once it gets back into the low to mid 20s, each of the last two bear markets, that's where we've kind of seen the VIX bottom, and we've seen the market top short term. So that might be something to watch. I'd also point out too that in November and December, the VIX, as it was moving higher, tended to struggle right here at about 22 to 24. And on the last big pullback that we saw in mid-December, we came back down to about 22. So I think it's moving into a zone right now where we might see a bottom on the VIX initially. I'm not saying it has to happen or it's guaranteed. It's just something to look for, because if the VIX bottoms and we start seeing fear rise again, that will likely end the short-term rally in stocks. And the S&P 500, if we pull that up for just 1 second, again, keep in mind that if we go back and we look recently, and I'm going to go back all the way to the beginning of the year, but if we go all the way back to February and January, you can see that initial low down here. That was at about that 25.31 area, and the breakdown came below that level on some pretty heavy volume that we saw in December. Now the rally takes us back up close to that 25.31 level, not quite there yet, but getting close, and also the declining 20-day moving average currently at 25.47. So as we move up, and hey, I hope I'm wrong. I hope things keep going up. I hope we're able to sustain this move to the upside. But I do think we are approaching now one of the key short-term tests on the S&P 500, something to watch maybe later this afternoon or maybe over the next couple of days. All right, I think we ought to get into that final segment.
Yes. Momentum sleepers.
Yes.
That was a little difficult for me. I don't know about you. I wasn't sure which way I wanted to go as far as the sleepers. Did I want to go for what looked like shorts? Did I want to go for what looked like a good place to go long, or just at least to the upside? I did my scan for dogs. That's the scan I do to find really good shorting opportunities. And interestingly, even with the craziness of this market, I had no takers. There were no results for my scan for dogs. So that gave me the indication that, it might not be a bad idea to look for some potential upside moves. And so I went in and I ran some scans and everything. And really, I just sort of picked the ones that looked interesting to me. There's only 5, and some of them are kind of interesting ETFs, which I'll start with. The 0 to 5 year TIPS bond ETF, STIP. This one I thought looked very interesting in that, notice the price bottoms are mostly even here. And what happened with the PMO during that time? We're getting rising bottoms. And we're almost to positive territory here for STIP. And so I am looking for, we got the breakout here above the low here from July and the top here from April. So we got that breakout. So the question is, well, where is the next line in the sand here? And what I am looking for, if you want to go on the safer side here, I think you could really look for that move, up to that 98.10 area. But I'd be looking even higher than that. I think you could make a case to get all the way up here to 98.40. So I think bonds, especially when we're looking in an uncertain market, a lot of times are a good place to go. Of course, these are the short-term ones. So just keep it in mind when you're looking at these. But you can see the trading range here, and we're near the top of that trading range. So that's what I would just kind of keep an eye out. If you want to get in now just to get an early opportunity maybe on catching the upside move here, just again, with all of the ones that I'm going to talk about from here on out, hand on the wheel, guys. You've got to keep very close attention to anything, I would say, if you get back in. Currently, I'm still completely in cash because I don't feel like I have the time to really make those moves and watch them that closely. When I feel like I've gotten a handle on the end of 2018 and the beginning of 2019, I might start looking in that direction. But I think bonds might be a possibility there. The other one that I had that I was going to look at for you is VIV. And this is Telefonica Brazil. Now, we just looked at some of the Brazil ETFs, and for whatever reason, I mean, they are looking a bit better. This one has been really quite boring. Let's put it that way. I mean, we have been in a trading range, but I think it's been a pretty good trading range in which to get involved in. What I really liked when this chart came up for me, number one, what's happening today? 50 is just now crossing above the 200-day EMA. This stock has been in a declining trend for quite some time. I think you could make a case for a possible reverse head and shoulders. This is your head, a little bit of a shoulder there, possibly complex shoulder here, and that supports or that trading zone. But 50 is crossing above the 200. That means it's moving into a bull market configuration. And you can see that PMO was declining. All of the bottoms were declining. And what was happening with price? We were starting to see those rise. That is considered a reverse divergence, and it's a good one. It's positive. So I like to see the breakout. I think we should, I'd like to see it get above that 1250, but you can see in the thumbnail, we did at least get up there. I would be looking for the breakout and a move possibly to that 1325 area. So again, hand on the wheel, guys. These are all, it's like I said, I'm not trading right now. It's too volatile for my blood and my accounts, but these are some possible ideas. IQV, and this is in the healthcare sector, which I like right now, based on just the fact that the market is a little bit crazy here, and I think that healthcare tends to be a defensive area. I mean, the look at the of this one as far as a momentum sleeper, we got the turn on the momentum, and now we're starting to see a bit of a a pullback or just a pause on this little bit of a move here. And so I think there is some opportunity left on IQV. You've got a PMO buy signal coming in oversold territory. 50 is still above the 200-day EMA. And, we broke up above that on, you can see back here from Monday, and we haven't quite gotten above that intraday high and the close from Monday. I would really like to see that, but just getting this sort of pause pullback, I think is positive anyway, and we're holding on to that 112.50 area. And so if we can hold that, I'd be looking for upside move to 127.50. And then just two more for you to consider. In the medical equipment area, tactile systems technology, and I believe I saw this on the downgrade list earlier today, but I like it. You've got the momentum has switched. You've got that bottom. The PMO is starting to climb upward toward a PMO buy signal. But again, we have to be careful. You can see we had a fake out back here where the PMO started up. It looked like we were going to get the buy signal. And then, like I said, it turned out to be a fake out. So let's just keep a close eye here. But 45, I think, is a nice level to get in on, just because you can see right back here, back in June, that was a pretty good low on it. And then I would just look for that move up toward the 5250 area right here, or just really to test that 200-day EMA and get back above it. So that was one. And then my final one is going to be XNCR. I think this is another healthcare. Yep, this is a biotech, so be aware and careful with these. They do tend to be quite volatile. I've got a PMO buy signal that is on its way. You can see that we've been in a rising trend here, and we're now starting to pause. But I still think there's still, I still see some momentum to the upside left here. We broke above the $35 level. That had been, look at these three bottoms and a top back here in March. That's a pretty serious area of overhead resistance, and we got above it, traded above it most of Monday. We did take a dip to the downside, but as you know, most of the markets did and are now on the positive side. We got a new intraday high today. So I think this one could be an interesting play to the upside as well. But, you know, really hard for me to look for upside possibilities. So I don't know. What do you got for us, Tom?
Yeah, I'm thinking the same thing. I'm thinking that mostly from the short side. I mean, the market has room to the upside. I wouldn't be surprised. I mean, in minimum, it could go up, you know, like I said, 25.30, 25.80 in that range on the S&P. And then if we looked at the weekly chart, I don't have that up right now, but if we looked at the weekly chart, we could probably look at the 20-week EMA on the S&P, and that potentially, you know, if we got above that and closed above it on a weekly basis, I would begin reassessing bear market strategies. But I don't think we're going to get back that high. But so those are some areas. So I think because we've already rallied some, I think that the risks of jumping in now on the long side don't warrant doing so. So I'm focusing on short positions. So the first short position is NLS, Nautilus Group. By the way, all of these short positions are off of my week earnings chart list, which I've now developed. Since we are in what I think is a bear market, I want to have those candidates ready for shorting on bounces in the market. And so Nautilus is one that came out with very weak earnings. You can see back here the huge gap down. It rallied off of that for about 3 weeks and then continued its move down. This recent rally has gotten us back to the 20-day moving average. So this is an area where the reward to risk favors a short position, because if I closed above the 20-day, or I could even put it intraday, you know, maybe 20, 30 cents above the 20-day, I can manage my risk on a short on this bounce. So that's one thing. I do notice that I don't have a volume on these. So let me pull. I wanted to see what that volume was on NLS. There we are. Yeah, so on this move to the downside, you can see the volume was pretty heavy. We did rally back, but as we've been moving higher, the volume has been dropping off. It's going to be a pretty interesting finish today to see whether or not we can break through that 20-day moving average. Some others, let's take a look at AutoNation AN. Now, this one is above the 20-day, but look at where the breakdown occurred. That prior low back in third week of November was at about 36.5. Today's high, 36.59. Now we're all the way back down 35.96. Looks like it's tested that overhead area of resistance and is now starting to move back down. So I think AutoNation is one of these. And we look at them and we talk about momentum sleepers. These are ones that had clear momentum to the downside. And with this rally, it's kind of like, oh, well, maybe they're okay. Well, they're probably not okay. They're probably just bouncing here in the near term. APO would be another. This is a global management company, Apollo. Another 20-day test. You're going to see many of these stocks. Look at the volume trends on APO to the downside. I think there's a lot of distribution taking place. Got a short-term rally in place with the overall market, but I think that 20-day is going to be difficult for APO. CF, which is CF Industries. Here we had a low between, or a prior support area, 43, 44. You can see there was gap support between those levels at about 43.60. Well, we finally broke down below. Volume was pretty heavy, and now we're back up into that 43, 44 zone, where you can see we had a long tail there that failed. We haven't been able to get a close above 44. So I think this 43, 44 area is an interesting short area on CF. FISV, I believe this was my setup from Monday when I did my blog. I know Fiserv was one of them that I was looking at pretty closely. But here, big breakdown. You see the double bottom coming across here at 74. Broke down on big volume, light volume going back up, testing 74. Even with the market trying to rally today, this one's struggling. I suspect it's going to move back down towards 69. PKI, Perkin Elmer, another one that broke down. I think the support level is pretty clear around 78.5, 79. Got back up close to that on Monday, starting to weaken again today, although we are off the earlier low. I think closer you get to the 20-day here, the better it looks on the short side. Terex, TEX. This one broke down. You can see the volume again. Volume trend's weak. We rallied back, but look at the volume on the rally. Really almost no volume. Trying to get back up to that 20-day moving average. I think it's probably going to make another push back down for 25 and change to test that low we saw on Christmas Eve. Let's just take a look at maybe two more. SYY, Cisco. This is the food company, not networking. But you can see the support that was established on the huge selling back on November 5th, down at around 63. We broke below it with volume expanding, got right back up to 63, starting to roll over again. And the last one is True, TRUE, TrueCar. Again, breaking down. I think you're going to see a lot of the similarities here. Failure at the 20-day moving average, and that is about where we are now. We got close back last Friday, and not too far off of it today, trading at 921, and the 20 days at 942. I would suspect that 940, 950 area is going to be very difficult for True. Okay, and that's what we had for our momentum sleepers. Erin and I both agreeing kind of hard to get too excited about the long side as we open up 2019. And there you have it. Bunch of stocks possibly to short.
Yep. Or in my case, they were actually buy side on the short side, the short time frame.
Oh, okay. Yeah.
Yeah, I know. Crazy.
Yeah. We're both I think it's safe to say that we're both a little bearish going into 2019. How's that?
Yeah, I think that's probably correct. Oh, here's our poll. How are our viewers thinking we are doing going into 2019?
Yeah, and the NASDAQ, of course, I follow history pretty closely, and it didn't really work out too well in December, although the strongest part of December is between Christmas and New Year, and that is when we saw the rally in the market. So it did get a little bit right at the end of December, but typically December is a strong month, and that was certainly not the case. But looking back over the last 47 years, the NASDAQ's best month has been January, and those annualized returns are pretty strong, 31.72%. So we do tend to see the NASDAQ move higher and technology move higher in the month of January. And the question was, how do you think the NASDAQ will finish January 2019? And almost half say lower.
Mm-hmm.
What did you say? What?
What did you say?
Oh, we said that at the exact same time. I think it's going to be lower. I think there's going to be a lot of volatility and a lot of whipsaw from where we are right now. But I think because we've already recovered so much, I'm going to say lower. I do think that everyone feels like, okay, now the market can't go anywhere but down. That probably means we're going to be a little stronger than most people think to open up. So I could see it. I could see it both ways, but I got to make a decision. So I'm going to go lower. How about you?
All right. I said lower, but I think everybody probably guessed that that's what I said. So, yeah, I mean, I'm with you. I think there's still a lot of volatility that's going to have to be that we'll have to shake out and shake off before I would get too excited about, a serious rally or something to the upside. But of course, you can't go down every day. You have to go up sometimes. So like I said, just beware when we do start to move higher. Just beware of the hype out there, because I can guarantee as soon as we start to make that move to the upside, break out a little bit, boom, done.
Mm-hmm. Well, I think too, today's action illustrating one final comment here, illustrating the volatility. I mean, the Dow was down 400, the futures were down 400. And here we are now with the Dow up 65 today. So really the volatility goes both ways. It's not always down.
Exactly.
But there's your upcoming schedule. And do want to thank everybody for being with us today. Thanks so much for your support in 2018. Stick with us in 2019. Tell your friends, family, everybody come in and check us out. 2019, we'll try to keep you up to date as best we can on the goings on. Please remember to complete the survey as you exit. It's located below the video player. We'd love to get your feedback and hear what you think of Market Watchers Live. Quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. See you back here tomorrow. Happy trading.